financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz. November 13th, 2017. Year is just about shot, and looks like the economy might be following it. Well, we are seeing public pension funds get into ever more dire straits. We're seeing the yield curve flatten. And what about junk bond yields? How bad is that going to go? Hey, be part of the show. Email us at kl@kerrylutz.com. You are the most valuable part of the show. Let me hear your voices. Twitter feeds at Kerry Lutz. And John Rubino is here with us now. So, John, what of these steepening junk bond yields? Is that portending something really bad unfolding, or is it just the course of markets?
Hey, Kerry. Well, there are definitely signs of stress out there. Maybe we should start with the overall yield curve and then move into what's happening with junk bonds, because that's sort of a related issue. But the yield curve is a pretty big deal in the U.S. That's the difference, generally defined as the difference between what 10-year Treasury bonds yield and what 2-year Treasury notes yield. And it's important because when long rates are higher than short rates, you can make money by borrowing short and lending long, which is what banks do. So the banking system is generally considered to be healthy when it can do that, when there's a wide yield curve, when the yield curve is very positive. In times of stress and financial slowdown, the yield curve tends to compress and sometimes even goes negative, where 2-year paper yields more than 10-year paper. When that happens, historically, you get a recession about a year later. If you look at a chart of the yield curve, it shows a steep drop into negative territory, and then a recession happens. Well, we're heading down. We're not into negative territory yet, but we've gone down from about 3% at the beginning of this cycle. In other words, 10 years yielded 3% more than 2 years. And we're down to below 1% right now with a kind of a steep downward trajectory. So let it go a little bit further down, let it hit zero or drop a little below zero. And that's a historically reliable recession indicator. So this is something to watch. And it implies that there are stresses building up in the financial system now that will come to a head if they continue a little bit longer. So that's one thing that's important and definitely worth watching. And then something that's related is junk bonds. You know, when the riskiest kinds of bonds, which is, junk is basically when you lend money to somebody that may or may not be able to pay you back, and they have to pay you a high interest rate in order to convince you to give them your money. When those things start behaving badly, that's also kind of a leading indicator of trouble in the economy. And junk lately has started to fluctuate pretty dramatically. What you're seeing is outflows from junk bond ETFs and some new junk bond issues being pulled because they couldn't generate enough interest, and the price of existing junk bonds falling, which is to say their yields are rising. So at the same time that you're seeing spreads compress in the Treasury market, you're seeing spreads start to blow out in the junk bond market. In other words, junk bonds are starting to yield more and more relative to super safe Treasury bonds. That's another sign of stress in the economy, and one that is a pretty good recession indicator when it reaches extremes. It's not there yet. This is kind of an early stage of the process right now, but junk is starting to signal that it's time to start paying attention to stresses in the credit market.
Well, junk bonds for your average person are a really bad idea because only the pros can really make money at them, right? I mean, nobody else. You make money when everything is looking fine and dandy, everything's going great, but the average person doesn't know when it's time to get out. And because Joe Sixpack or whatever Mary gray collar worker has been searching for yield because you've been looking to make up the difference because interest rates are 25 basis points, you wind up in junk because some brilliant financial guy said, oh, yeah, junk is good. Nobody's ever lost money in junk before, right? And, right, sure thing. Like,
Well, here's the dynamic with junk bonds. Yeah, because you're right. In times of fairly low interest rates and in good times, junk bonds don't really default a lot. They have really low default rates because they can borrow more money to refinance their old junk bonds. And so financial planners and other financial advisors look at that and say, well, look, we've got these low default rates and interest rates that are real. They're quite a bit higher than what you get in your bank CD or something like that. So they put their clients into it. The problem, though, with junk bonds is that when you buy them at par, in other words, 100 cents on the dollar, the risk reward calculus gets really unfavorable because you can only make the interest rate when you buy a junk bond at par, and not much more than that in any event, because if the price of the bond goes up above par, the issuer just calls it. There are call provisions with junk bonds and replaces it with something else. So they buy you out at 103 cents on the dollar. And so that's all you make. But the downside is zero. In hard times, junk bonds act like equities and they just collapse. And you see that over and over again where the economy starts to get into trouble. And all these junk borrowers who looked pretty safe when they could borrow infinite amounts of new money see their credit cut off because people get nervous. And that's one of the things you do. If you're a banker, you stop lending to risky clients. Or if you're a bond fund, you stop buying the bonds of the most risky companies when you get nervous. And so junk bond issuers see their credit vaporize. They can't borrow any more money. And so they got to live with their existing cash flow, which is drying up because the economy is getting unstable. And a lot of these bonds literally go to zero. A lot of other ones go to 20, 30, 40 cents on the dollar. So you can lose half your money or more in a portfolio of junk bonds when in the best case circumstance, you were only going to make 6 or 7% a year.
Yeah.
And so it turns out to be an incredibly bad deal for like 2 years during a financial downturn. And since we've had 6 or 7 really good years in junk, historically speaking, we're overdue for that 2 really bad year stretch. And we're seeing the early signs of the market entering that kind of a time. This is what happens at the beginning of what turns into a junk bond crisis. So, it's possible that the world's governments step in with huge amounts of new credit or guarantees, or they change tracks and start cutting interest rates instead of raising them in the short run. And that shores up the junk market by flooding them with liquidity. But if that doesn't happen, and it doesn't look like it's going to, it looks like the Fed is on track to either keep rates stable here or start or continue to raise them a little bit. It looks like the ECB is finding it necessary to at least talk about tapering and maybe have to do that in 2018. So the environment should be a little tighter going forward, just based on what the big central banks are talking about doing now, than it has been in the past, which means the tightening in the riskiest parts of the credit market ought to continue. And junk is so over leveraged right now. They've had such a long stretch of good times that there are some really high profile junk bonds out there that could easily blow up. Look at Tesla.
Yeah.
They've been borrowing in the junk markets at favorable rates at issue, but now their bonds are trading below par. And if they have to borrow more to ramp up the production of their newest model, their newest electric car, they're going to probably get very unfavorable rates. And so their existing junk bonds will go down further if they have to borrow at higher rates, which means we've got a high profile casualty looming in the junk market. And that's the kind of thing that spooks people. People look at somebody like Tesla or Netflix or, name the other big high profile junk bond issuer and say, wow, if those guys can get into trouble, then what am I doing with all these no-name crappy company junk bonds in my portfolio? I got to dump these things. And then you see a panic out of that sector. And the door to get out is very small. These things aren't liquid. So if people decide they want to sell, you got these air pockets under the prices of a lot of these junk bonds. By the way, one of my first finance jobs was as a junk bond analyst in the 1980s, just as the junk market, which was the major junk bubble that has ever happened, blew up. So I saw this firsthand. Mm-hmm. And what happens is a lot of funds that own junk bonds are not allowed to own busted bonds. In other words, if a bond drops to a certain credit rating or they stop making the payments or whatever, a lot of funds that own them now have to sell them because they're not allowed to own bonds that are in that category. So they have to sell them at any price. And you see these things gap down by 20 or 30 cents on the dollar, just huge moves for bonds. And there's no buyers at the bottom at first. Eventually the vultures come in and buy bonds worth 40 cents on the dollar for 20 cents on the dollar, which is great if you're the guy doing the buying at that point. But if you're the person who bought it at par at 100 cents on the dollar, none of this is good news for you. And that's what's coming if financial conditions tighten just a little bit more from here. So a very interesting point in the cycle now.
Oh, yeah. Very interesting. It's funny that you were there right when everything really hit, when it all hit the fan in junk bonds, because so many people have forgotten, John, that ever occurred. And you wonder, how could they not know? Those were momentous events at the time.
Oh, well, Kerry, that was 3 cycles ago, and we've gotten it together since then. The central banks now, today, are so smart that they know how to manage an economy to avoid stuff like that.
Right.
So there's no reason to worry if you're in junk right now. That's what people think.
There isn't? Now. I didn't know that. Thanks for clearing that up for me.
Oh, sure. Yeah.
I really do appreciate it. But look, people just don't learn Well, what do we learn from history? The one thing we learn from history is that we don't learn from history, right? Mm-hmm. Yeah. Isn't that it? Really?
That is it. Because otherwise we'd be terrified, because you take any historical measure of valuation out there for any major financial instrument, and it's screaming, run for the exits.
Oh, yeah.
But this time is different because the world's central banks, they have our backs. If anything bad happens, they will step in and start buying financial assets with trillions of dollars of newly created currency, and we'll be made whole, or we'll make huge profits by not fighting the Fed and the ECB and the Bank of Japan. And you know what? For the past 5 or 6 years, that's been the case. It's been completely true that central banks have been able to manipulate asset prices upward to levels that are at a minimum surprising and worst case scenario completely terrifying. And they've been able to do it with minimal volatility. Not only are financial asset prices going up, they're not bouncing around on the way. There are no peaks and valleys. There are only new peaks. And I think the Achilles heel of that strategy is that, yes, central banks can control asset prices because they can create infinite amounts of new money and credit with which to buy those assets, but they can't control the value of their currencies. So as long as the dollar and the euro and the yen are seen as excellent stores of value by the global financial markets, they can play these games and get away with it. But as soon as people start questioning the viability of these currencies, then the game ends and everything falls apart. So that becomes not a question of if, but when. It's going to happen if they keep this up. We'll get the Austrian School of Economics crack-up boom, or some other kind of financial crisis, the Minsky moment. There are a lot of names for what's coming, and they're all terrifying when you see what those names refer to.
Can you imagine when, the credit markets implode, and what are people going to do here, John? What do you do?
They're going to panic.
You're ready.
Yeah.
You and I are as ready as you can be, but are we ready enough? That's what I want to know. Are we really ready enough?
Well, this time is different because we've never had a whole world of central banks with unlimited printing presses willing and able to use them at the drop of the stock market. A 3% drop in stocks gives you some kind of a response from central banks these days. So this is a different world in that sense, but it's also a scarier world from the point of view of a currency crisis, because we're creating the conditions in which people lose faith in these forms of money that central banks are using to manipulate the rest of the financial market. Because in order to, prop up the bond market, prop up the stock market, you got to create a lot of currency with which to buy those equities or those bonds. And you're seeing central banks do that. The Swiss central bank and the Japanese central bank are huge buyers of equities. The US and the European central banks are huge buyers of bonds, including, in the case of the ECB, corporate bonds, and including, in the case of the US, asset-backed bonds, housing bonds and stuff like that. So at some point, the amount of new currency that has to be dumped into the banking system in order to support asset prices becomes so unwieldy that it starts to affect currency values. And then boom, it's over. And this is also coming at an interesting time because we're seeing private sector monies arise that are competitors of the big fiat currencies and are kind of showing them up in some ways. Bitcoin is up dramatically versus all the major fiat currencies. And that's a sign that the markets are starting to look around for alternatives. Now, when gold and silver start going up, which they will, then that'll be another signal that money is flowing out of fiat currencies and into better forms of money. Because a rising price for something like gold and silver is driven by people converting their fiat currencies into gold and silver. In other words, they're dumping fiat and they're buying sound money. So let the price of precious metals start to rise dramatically. And people who understand the dynamic will interpret that correctly as a flight to quality in the currency markets, which means that the euro and the yen and the dollar are now the low quality assets. And that's going to be a big deal. When it happens, it'll be huge. And the people who bet on financial assets, which require huge amounts of new dollars and euros and yen to be created in order to prop up the values of those financial assets, will be the losers, because the governments of the world won't be able to prop up financial assets with their depreciating currencies. That'll just make it worse rather than better. And then it's game over. And if you own a junk bond portfolio, forget it. Or if you're a creditor of Chicago, you might get 20 cents on the dollar back from these bonds that were investment grade when you bought them, and are now junk, that are falling more deeply into junk territory every day. These things are going to be huge losers, and they're going to affect the behavior of the people who own them, which is to say they're going to lead them to sell other stuff. They'll sell the things that are up in order to pay for the things that are down. And you get this cascade failure of this Ponzi scheme, which is what the stock and bond markets of the world are right now. So that's out there, Carrie. We can't know whether it's later this year or 2018 or 2019, but at some point, what's happening now can't be maintained. And it will fail. And when it fails, the guys who trusted the system are the ones who are going to be hurt most.
And trust in the system, trust is needed most when things are worse, but that's when the trust is least in the system, right?
Well, yeah, trust evaporates when there's some kind of a crisis that shakes the belief that you had that the guys in charge know what they're doing. That's what happens in every big crisis. I mean, look at 2000, when somehow we got the idea that tech stocks would always go up, in part because the government liked all the capital gains revenue that was coming in, and they would engineer a situation in which they got to keep generating that capital gains tax revenue to balance the budget, et cetera, et cetera. Well, they didn't have the ability to keep tech stocks going up forever. It blew up on them. The same thing with the housing bubble. We actually thought, or a lot of people thought, house prices would always go up because the government had decided that every American should have a house. And they were engineering the financial system in order to make that happen, and it's sort of the same thing now. Stocks and bonds will always go up because the government wants them to go up. But governments can't control this kind of thing indefinitely, just for a little while. They can fool us for a while, and eventually people catch on, and then the emperor is perceived to have no clothes, and the cycle begins again.
And the cycle begins again, and the foolhardiness of the public of always looking for something for nothing can never be satiated, right? It can
Well,
never...
we love free stuff, Gary.
Yeah.
That's human nature.
Something for nothing.
Easy money is really hard to resist, and I totally get that,
Yeah, but easy money turns out to be very expensive money, John. Eventually, it works for a while. At some point, all these people who have seen your wealth go way, way up over the current bull market in stocks, you're going to look at it and say, gee, it could go down. I better at least lessen my exposure. Maybe I'll get 30% in cash. And when enough of the herd does that at once, John, you know what's going to happen. And they just need to be a little spooked. Maybe it's a major default in municipals. Maybe it's a major default in junk, but it's going to happen. There is going to be a precipitating event, and you are all going to be running for the exits at the same time. And you know what happens in a movie theater when somebody yells fire and you all head for the exits, right?
Yeah.
You get crushed.
You can't get through.
Yeah, you get crushed.
and so if you're a long way from the exit when somebody yells fire, you're pretty much screwed. And that's what you want to avoid with your money, just in general. As a general principle, it's long-term best to avoid losses rather than maximize gains. If you just don't suffer big losses throughout an investing lifetime, you tend to do really well. But if you have a 50% loss in 1 year, it takes you a really long time at, let's say, a historical 8% return to get back to 100% after you lost half your money. So you want to avoid that at all costs. And one way to do that is just not leverage yourself to the hill. Don't trust the powers that be and jump in with both feet. And unfortunately, by the end of a cycle, when everybody's been making easy money for 5 or 6 straight years, it gets really hard to have that kind of self-control because you've passed up so much by being cautious that you want to get caught back up with the smart people who stayed fully invested the whole time and used margin and other kinds of leverage, options, et cetera, et cetera. They're the guys who made all the money in the last few years. Well, you want to be one of them. And so the temptation becomes overwhelming to try to get caught up with a big year, when everything's going to go up in 2018 because, the crisis might happen in 2019, but it's not going to happen right away. So let me do the greater fool theory thing. I'll buy something now, I'll sell it to a dumber guy 6 months from now and make a big profit. That's the thing that kills you if you're an individual investor or a professional money manager.
Agreed.
Herd behavior is deadly.
Yeah, and it's predictable, and it's just not predictable from a time frame perspective. But it is predictable that it's going to happen, and that when you have a herd, the weaker members get trampled by the other ones when they get spooked. And it's a great analogy. It works. Anyway, hey, don't forget, our webinar is going to be this Wednesday, 9 p.m. Eastern Time. Any questions, comments, email us, kl@kerrylutz.com. Twitter feed's @KerryLutz. Been really burning up lately. And the Facebook page is Financial Survival Network. John, I will see you on Wednesday.
Thanks, Gary. Looking forward to it.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival